Portfolio Builder members, welcome back from the long weekend. Start off with a quick disclaimer. Trading is risky and you can lose your entire investment. These results are based on hypothetical model portfolio and not real money trades. This is not financial advice. Some staff does take our trade alerts. They receive them at the same time as the rest of our members via Telegram, text, email. See our full disclaimer at the link below. And for those of you who want to automatically get our live stream and daily video, please make sure you subscribe to the channel with the link below and click that little bell icon. We only produce one video a day. It is a live stream, so you have the opportunity to chat with me live, plus watch the recording later if you can't make it. And a quick summary of the various strategies you can put to work to follow our program. If you have $100,000, excuse me, if you have $100,000, the recommended allocation is 100 shares in the SPY, where we trade Monday, Wednesday, Friday. 100 shares in Facebook, which we trade on Tuesday, which is today's trade alert. And then 300 shares in the TLT, that's the U.S. Treasury Bond ETF. And then finally, this has been our biggest returner of the year, is a 10% allocation in gold. Our current recommendation for exposure to gold is GDX. And so the precious metals and bonds have been doing incredibly well this year, although we have generated very nice returns in the equities portfolio as well. Now, we do have a different setup that works for some folks. If you want less risk and less capital to put up front, for $66,000, you can follow with 100 shares of the SPY Monday, Wednesday, Friday at noon Eastern, 200 shares of the TLT. This again gives you approximately 45% equity portfolio, 45% bond portfolio, and then you would have $6,000 worth of GDX or 200 shares of GDX. And so this still requires that you're willing to do a 2-minute trade 4 days a week. For some folks, they want to trade less, and this is actually our highest returning combo. It does put more risk into the equity side. Instead of having the SPY ETF, which represents 504 different companies inside an ETF, we're now picking the best stock for the time period and doing a weekly trade. And if you wanted to follow this allocation, you have 100 shares of Facebook on Tuesday and 100 shares of the TLT on Thursday, bringing your total capital to about 37 to build this out. And you put 115 shares to buy and hold GDX. Now, if you have more than 35,000 to put to work, you can just multiply this to create the same ratios. Now, just so everybody knows, on the Facebook trade, we're currently playing Facebook, expecting that the Fed will lower rates in September, potentially just enough to keep stock market very happy and maybe upset the bond market, which a lot of the big names have been skeptical on all year. In fact, we're seeing people like Ray Dalio, Jeffrey Gundlach, all the bond kings are underperforming this year as they have not expected the bond market to get so crazy. Our plan is to hold Facebook until the SPY is towards around $300. From there, we will rotate into Microsoft. I'm then expecting the S&P 500 to climb considerably higher, and at that point, we'll switch to silver. So my general thesis with our strategy right now is that the big picture is as such. Now again, I'll show you guys a big picture. One quick thing, if you're just getting the link to the video and you're not getting the real trade alerts, your free trial has probably expired and you need to activate your account. Call Dean at 505-322-7515. He'll talk to you about which strategy makes the most sense for your circumstances and then get your free trial activated. So let's take a quick look at the big picture here. This is one of the most important charts we all need to focus on, and this is the dollar index. So over the weekend, the Chinese have been devaluing their currency, funny enough, by about 5% over the past month, and all of a sudden we see a 4% jump in the dollar index. So what I'm expecting right now is that China is going to have a dramatic slowdown. They're out of credit. They can't keep building all these ghost cities, and they're running out of dollars, which they need to be able to buy all the things to run their economy. Nobody wants to exchange in their currency because it's not trustworthy. There's no law. They just really steal, cheat, subsidize industries. Sure, they're a huge economic engine that's been really fueling the last 10 years of bull market around the globe, but now it's become quite apparent that they have flooded their economy with money. They're not letting capital flow out, and they're artificially controlling the exchange rate of their currency. So how long can they keep that up? I'm expecting their currency will continue to slip, which is going to cause all the other emerging markets to devalue their currency, which will continue to push up all U.S. products. So overall, my expectation is without China or Trump creating news wires that freak out the world, that we're going to see emerging markets really suffer. Their bond yields go into more and more negative debt, yielding debt, and for funds to really escape to the one outlet where they can find yield. And so the U.S. dollar provides profit just with a buy and hold strategy right now relative to all the other currencies. So that's number one. Number two, the U.S. Treasury market makes it possible for there to be all this negative yielding debt. If the bond market had no escape avenue to create a positive yield, this negative $16 trillion of sovereign debt around the world would implode on itself. So I do suspect the U.S. Treasuries will continue to be a very hot product. And then for the best yield you can possibly get, you have to flip over to the U.S. stock market, which despite all this trade war talk and all the recession fears, the inverted yield curve, still has very strong profits. We're still seeing record-breaking earnings out of the most important companies in the S&P 500. And sure, we're seeing the little guys, the middle of the U.S. stock market being weak. So that does make me think this won't be a long-term bull market in U.S. equities. But in the short term, you got to think, where is all the capital going to flow? So they've already pushed the bond market to pretty absurd negative yields. And I think they're just now waiting for the central banks to come cash them out. And where is all that money going to flow after that? So people are using credit to speculate on the circulation of bonds out there. They're driving these yields lower and lower, essentially demanding that the central banks cash them out. And then I'm expecting a huge flood of capital to find their way into U.S. equities. So we'll take a look at the long-term difficulties of this. The catch to all this is that I do expect Trump, every time the stock market is back at a very healthy level, probably above 300 on the SPY, I believe he's going to get awfully brave and continue to jab his buddy President Xi in China. So again, our Tuesday trade, you can expect to play the Facebook, as the SPY, I believe, is undervalued. Once we get back to perhaps a relatively fair value of the SPY towards 300, expect for the Tuesday play to rotate into Facebook, and then, or rather into Microsoft. And then once we get to nose-bleeding levels, we'll be switching into silver, expecting some more trade tensions. So let's take a look at our portfolios, the strategies, the returns, the most recent trade alert, and then we'll jump into all the big news that's dictating how we play our portfolio. Okay, so let me zoom in on this so we can all see. So first of all, our portfolio has 40% in the Monday, Wednesday, Friday SPY trade and only 12% in the Tuesday play. And now for you, depending on what your schedule looks like and how much capital you put to work, you can either just do the SPY trade Monday, Wednesday, Friday, just do the Tuesday trade, or do both and allocate your capital accordingly. So that's totally up to you. The Tuesday trade is up 17.5% from conception. But if we go to the monthly return, you can see it's up 22%, 22.8% just this year. And it's had some bigger volatility than the SPY program, which is its goal. So we are trying to achieve a bigger return with more risk. We've had some losing months in this portfolio, negative 4% in December, negative 1.3% in May and July. But outside of that, it's been very healthy returns that have dramatically outperformed the SPY portfolio. So if you do pick up this portfolio, expect bigger swings to the upside and to the downside in order to achieve better returns. So that is a look at our monthly return on the Tuesday play. And again, if we combine all the strategies, you can see we've only had one losing month. In July, we're up 16.5% this year total. If you combine all the strategies together, 2% in January, 1.7% in February, 2.7% in March, 1.2% in April, 2.2% in May. June was 3.2%, best month to date. August was very strong because of the bond portfolio. Now, I do have some bad news for those of you who played our Thursday play. For the first time this year, I bet down on the bond market and we got wrecked. Didn't lose a lot, but we're totally off on that. So expect us to go back with the market on Thursday on that play. Other than that, that portfolio has had an incredible return. And our buy and hold portfolio in precious metals and crypto is doing very well. I'll take a quick look at that. Now, this portfolio is really up over 200% if we had just taken the initial investment. But as the Fed has completely reversed course and kind of flip-flopped in what they said they would do, we've been gradually increasing the capital allocated to this portfolio. So it started off with only 2.5% when the Fed was back in December saying that rate hikes were on autopilot and that quantitative tightening was going to run its full course. So that is very bearish for precious metals and crypto. But Bitcoin was at a very low price, and we put a 2.5% position in that, expecting that most likely the Fed would have to stop being so hawkish. Sure enough, they did, and as they've slowly but surely went from pausing the rate hikes and the quantitative tightening to dropping the rates by 25 basis points in July, now we've seen them pick up $15 billion in the 10-year Treasury. It's not really clear why they did that. They didn't say they were going to do that yet, but they have. Now we're all expecting either a 25 or 50 basis point cut in September and probably slow and steady cuts for the next year as the U.S. Bond market has to compare its federal fund rate to where the bonds are trading after they've been sold off by the Treasury. They're getting pounded to lower and lower interest rates. So again, my expectation is that the bond market's going to continue to drag these yields lower and lower, increase the bond price until they get confirmation that all these big central banks will come in there, peg their rates, start buying back all these bonds so the speculators can make a profit. And then that's when I'm expecting a huge potential run-up in U.S. equities. So that's our overall outlook. Right now, if you want to make your life simple in the gold portfolio, you just would have a 10% position in GDX. But if you do want to spicing it up a little bit, you can put 1.25% total portfolio in Bitcoin and 1.25% total portfolio in Ethereum. My outlook is that Bitcoin will probably pop up a little faster than Ethereum until the price gets a little expensive on Bitcoin. Then I'm expecting a big flood of capital to take profits on the Bitcoin rally and continue to diversify into Ethereum and other altcoins. I'm not ready to worry about any other altcoins other than Ethereum at this point, as it really is the only big different cryptocurrency compared to Bitcoin right now that has a pretty serious market cap. After that, it really drops off a cliff. So we are currently recommending an equal ratio of Bitcoin to Ethereum, but that should only represent a quarter of your buy and hold precious metal crypto portfolio. If you don't want to mess around with Bitcoin or Ethereum, you could just go GDX all the way. That's a gold mining ETF that's performed very well for us. This portfolio, even after diluting it down twice, still has a 50% total return, just with very, very little moves. You can see all of our trades right here and the current allocation. Okay, so let's take a look at the current trade alert. We had a nice return on this portfolio week over week, $1.71 or $171 per contract. The Facebook security traded from 182.21 to 184.30 for a profit of 209, and our caller cost 15 cents going in and cost an additional 22 cents getting out, which reduced our profit by 38 cents. But again, that's what makes our trade alerts safe. We can rest assured, even if an atomic bomb went off, we would get a guaranteed price for our shares of Facebook because we always own the put option below, and we're financing that put option by selling an out-of-the-money call option. Now, this is when we expect the underlying asset to appreciate rapidly, and it makes the most sense to let Facebook just run up back towards that 200, 210 level all on its own to generate our profits. Now, if I thought Facebook was going to trade flat, we would try to generate our profits from the options. But right now, my expectation is a pretty gradual, quick rise in equity prices leading into the FOMC meeting come September 18th, where we suspect the rates will go lower, which makes credit cheaper, continues this trend of corporate buybacks. And we also have some major central banks now getting their eye on U.S. tech companies as the best way to generate return. So that's an overview of that. Let's review how to get in and out of these trades for people who are new to the program. So the first step going into last Tuesday's trade was to buy 100 shares of Facebook, which you can see in step 2. And if you're new to the program, you don't want to buy the shares of Facebook until the Tuesday trade alert so that you can put on the option collar, which protects your capital. And so you can see going into this trade, we sold a call option up above the trading price, and then we bought a put option below. So we ended up paying 15 cents for this option collar. And this is a setup where we think the underlying asset is going to appreciate. And that's the easiest money in the stock market. It's not always an opportunity we can take advantage of, but right now we just got through a nice sell-off and we're expecting everything to bubble back up. So it makes sense to not be greedy and take a bigger credit on the short call option and instead sell a very far out of the money one and use that to buy our downside protection. So going into this trade, we essentially had the maximum risk of $1,000 and the maximum profit of $746. And again, we were short the call and we were long the put. We sold the call, we bought the put. Here's how easy it was to get out of that trade alert today. All we had to do was buy to close the 190 call and sell to close the 172.50 put. Now do note that we always have to buy to close the short position on our call before we can write the new covered call. So you always have to do that. Now in some situations, if our prediction was correct and the asset went up considerably, your put option may be worth only a penny. In this case, it was worth 13 cents. So we actually can sell that put option. If it's only worth a penny, you can just let it expire worthless. No big deal. But in order to put on the new trade, you absolutely have to buy to close the previous week's call option. Now again, I'm not going to reveal the exact trade alert for today because it's only for our paid members. So if you don't have the trade alert in your email, you need to call Dean right now at 505-322-7515 to activate your account. And this way you won't miss out on the trade alert that we're currently in today. But again, just to review how easy this is, it's a 2-minute trade. Step 1, from the previous week, you would have bought 100 shares of the SPY, you sold a call, you bought a put. This puts you in a situation where we have limited upside profit, but if an atomic bomb went off tomorrow and the Facebook shares crashed to super low prices, it wouldn't matter. We get $172.50 per share because we were smart enough to buy the put option, and we financed it with an out-of-the-money call option that has very little chance of actually getting to that level. So our profits will stop once Facebook goes to 190, and our losses will stop once Facebook goes below 172.50. So it sets you up to generate safe, consistent income week over week with no worry. There will be absolutely no no little management to the trade. We sit on this until next Tuesday at noon, and that's when we'll get out of this trade. So that's a review of last week's trade, and again, you can see the profit was pretty nice. Could have been more, but we made $1.71 a share, which is just under 1% return week over week. Okay, so with that said, let's jump into our live stream macro data and talk about the big picture, and then we'll get out of here and prepare for our paid member tomorrow webinar. Okay, so now what I have on the screen is my live stream doc, which if you click on the description box in the YouTube video, you can get a link to go to this doc and look at all this data later. So if you don't want to lose it all, just go to that doc, save it, and you'll have a copy of all the content in this video right here. Okay, so here's the first screenshot are the key tickers I follow daily. And the most surprising thing to me is the TLT continues to climb higher and higher. That's the U.S. Treasury 20-plus year bond market. And so that's the most startling thing to me at this point. We got through the tariffs. China's retaliating a tiny bit by devaluing their currency. Overall, I find that very bullish for U.S. equities, the dollar, and the bond market, as well as gold and crypto. But I would suspect the TLT would be calming down a little bit if the equities were going to rally going into this next Fed meeting. So this is something that is definitely making me question how healthy the stock market is. Now, it may just be that the bond market speculators are waiting for an exit event where the central banks announce that they're going to start up quantitative easing, which will allow them to mass exodus this position. So you got to think the people who have been speculating in the bond market are huge banks, and they know if they try to get out, it could create a huge sell-off, like a domino effect. And so they may not want to even try to get out of this position or let that yield on the bonds that are being traded back and forth rise at all until they get confirmation that they can exit the whole position for a decent price thanks to the central bank. So that perhaps is what they're looking for. So I'm going to stop trying to fight the trend on our TLT position. We haven't fought it all year. We've given up a lot of the profits by playing it conservative with our option caller. And for the first time in the entire year, we tried to point the trade downward on the TLT, and that will create a tiny loss in that Thursday trade. But I do expect that this trend is going to continue until we get a confirmation from the Fed that they're going to peg that rate and start to suck up all this speculative money out of the market. So we'll keep a close eye on that. Do expect on our Thursday play to remain bullish on that trade like we have the entire year. Here's a look at Facebook. I really like Facebook because it has no business in China. So a trade war with China really won't impact it very much. They have an absolute monopoly in the social media space between Facebook and Instagram. They have one of the two dominant chat apps. There are, of course, rip-offs of everything Facebook has in China, but again, that's not part of their business model at this point. Their revenue growth has been unstoppable. I'm expecting potentially record-breaking profits in Q4. And this doesn't even go into the fact that they're creating their own currency called the Libra. the Libra could be absolutely huge and help them really grow the revenues on this monopoly of users that they have. So everything about Facebook is really exciting to me. They have a clear moat around the castle, as Warren Buffett would put it, and they have no debt, just very clean book. Really, their only risk, I believe, would be the government trying to heavily regulate them. But it's hard to argue a monopoly when you give away all your services for free. So we just got off a $5 billion fine. They're getting hassled by Europe about the Libra coin. That's all great news for us in terms of creating a discounted price of Facebook to ride. We had the general sell-off in the market, so now we're picking up Facebook until, again, the SPY is probably around 300, at which point we'll go to a little higher quality stock for the Tuesday trade, which will be Microsoft, which has extremely low volatility. We'll ride that until it appears that Trump is confident enough to start poking at his buddy China again, in which case we'll rotate to silver. So that'll most likely be our rotation for the foreseeable future. Now, I am expecting an opportunity to jump back into Apple, but I'm also expecting a huge jab to the back from China at some point. So I'm waiting to trade Apple as a replacement for Facebook if and when China really puts a stab into the back of Apple in response to what America's doing to Huawei. So look for America to actually finalize all these sanctions against Huawei, and then a response in China that actually will hurt them because Apple employs some 1 million workers in China. That's the kind of sell-off and fear I'd like to see in Apple before we jump in and try to play it to the upside. So that's a kind of a plan for the Tuesday play. SPY, again, I'm expecting to bubble up over 300, potentially, who knows just how high this could go. At some point, I think the bond market's going to cash out to the central banks who are going to have to peg their yields, try to put an end to this madness of negative yielding debt, pick a rate that is still positive on U.S. Treasuries, but still competitive relative to all the other bonds out there, which are primarily in negative yielding territory now. And so this is all just looking like the bubble is going to expand, the everything bubble. So I am expecting the SPY to rapidly rise into the year. Unless, of course, China or U.S. aggravates the trade war to a greater degree than we currently have. Right now, it's just enough agitation to cause Chinese to devalue their currency, which is causing all the other emerging markets to devalue their currency, causing Europe to devalue. And what's left is tough for American exporters, but in terms of being able to sell our debt, positive. In terms of U.S. equities valuations becoming relatively greater because there's more currency out there than there was before, positive. Gold, more money supply, positive. Same for the, what you want to call it. Bitcoin's kind of like your rebel without a cause version of gold. Same for Ethereum. Which I do think has its place in the ecosystem for money, and why I like to continue holding that. But yeah, this TLT is just completely dominating the markets right now, and you can see something's got to give. And I think the only thing that's going to stop this trend is when the central banks finally cave in and say, all right, we're going to peg these rates, buy up all this speculative bonds that are out there, cash you guys out. And then that's where we might see the TLT finally slow down, and a huge rush of capital potentially will then flow into U.S. equities. So will that happen in September? We'll see what this Fed decides to do. And really the Fed's controlled by the U.S. banks. So it's a difficult time for these poor banks. Poor banks. We'll talk about that another podcast. LQD is the investment grade corporate bond ETF. This is one of the biggest drivers of U.S. equities, is simply corporations are able to buy for close to zero and turn around and use that capital to buy back their own stocks. In fact, they're buying back their own stocks from data I've seen, at a rate of about 10 to 1 of normal investors. So almost 90% of the market for buying U.S. equities to date has been primarily corporate buybacks. Now just wait till all these big banks and central banks rotate out of their worthless bonds that pay a negative yield into U.S. equities. That will be something to see. So until this chart breaks down, I'll be skeptical that the SPY has hit its top. Now, in terms until this puppy really recovers, the Russell 2000, we may just have this same setup where our FANG stocks are leading the way. The tech companies continue to make profits, no matter what's happening around the world, no matter what's happening in the economy, which is driving the SPY, concentrating all the capital into a handful of companies, and then the rest of the 2000 and the Russell struggle, which you can see clearly in this chart here. It's not looking super strong at this point. Okay, I like to keep look on some of the top Chinese securities. If these start to massively sell off, look out below for U.S. equities. They're highly correlated and a good, somewhat of a leading indicator to give us a heads up on our SPY and our Facebook play. Europe, again, may be in more trouble than China, quite frankly. We're all obsessed with what's going to happen between U.S. and China, but meanwhile, we can get a better gauge of how much China is struggling by looking at what's happening in Germany. While we don't know how accurate any of the accounting is from China, probably a lot of fake numbers, as it's illegal to go audit their companies. It's against the communist law. So we can look at how Germany's performing. And Germany's been struggling considerably, which we can see with their bond market. Here's the U.S. companies actually selling off to a greater degree than the Chinese today. But you got to remember, Chinese stocks have already been punished dramatically over the past year. So there's a lot more higher valuations in the U.S. equities at this point. And this was tiny sell-off today with a little bit of trade tension escalating between China and the U.S. Nothing huge. I think that they both want to relax the situation for a little while and let their markets rally a little bit before the next blows are made. But that's why we have the put options in case. I also think that they probably don't want to fight against the Fed potentially lowering rates come September. So my expectation is we break to new highs and then see a whole new escalation. Here's perhaps the most important chart. This is the yuan against the dollar, the Chinese currency against the dollar. So you can see over the last day it has been slowing down, which tells me perhaps a period of calm for the week ahead. But this is after they did spike it up a little bit over the weekend. They devalued by about 5% in the last 30 days, but popped it up even higher yesterday. And again, so you can see that going from 6.9 up to 7.2 as of just last night. If we look at the 5-year, we can see the last time China was challenged with its credit was in 2015. The currency conversion rate popped to almost 7. And then they essentially created a huge expansion of their currency, started up massive infrastructure projects with their Belt and Road Initiative, as well as housing within China. And now their debt to GDP is over 300%. And I'm expecting this conversion rate to continue to deteriorate, showing weakness in China, trying to offset the costs of the tariffs, but creating this domino effect across the world in terms of making pretty much every currency worth a lot less relative to the dollar, and also relative to its hard assets like the treasuries market and the equities market. Gold continuing to push to these new levels, which of course we're long. Silver's kind of like your hypey version of gold, and it is rocketing up. Just to get back to that 2016 level, it would have to pop above 20. So I am expecting this to slow down in the short term, and then we will get back into this. Again, our plan on the Tuesday trade is Facebook until the SPY is up above 300. Then we'll go to Microsoft. And the reason for that is because we don't know exactly when Trump or China will escalate. When they do, Microsoft will sell off far less than Facebook or any other company in the world. So when we're at nose bleeding levels, I'll rotate into Microsoft. And then once it just gets absurd and we can just tell the VIX is back to low levels, the market's prime for some tension, that's when I'm going to plop us right back into that silver ETF. So who knows? This might hit 20 by the time we even get to that point. But for now, I do like the Facebook overall for the Tuesday play. Oil, again, has two things to worry about. If it gets too low, that's a good leading indicator that global growth is going to crash. Look out below for stocks, and it means we should probably be loading up on our bonds and our gold. On the other hand, if it stays right at 60, I'd love it for our current setup. I think that'll just help support really everything. It puts no pressure on the Fed to raise interest rates because there should be very little inflation due to crude oil prices. And there shouldn't be any massive fear out there. So at 60, I'm happy to have our trade set up exactly how it is. But if this were to really start to rally more expensively, that could be very bearish for just about everything because it could put pressures on inflation and start causing the Fed to try to raise rates again. We saw what happened in 2018 when China and the U.S. Tried to lower their balance sheets and try to raise their rates. We had everything in the world crash. There was almost nothing that went up in value. That's kind of the concern if oil gets too expensive right now. It's just floating around there at 60, which is great. Oil companies can make money. There's no pressure on inflation, and it shows healthy signs of growth. Okay, German bond is what I've been using to try to get a picture of what may happen in the U.S. bond market. And again, Germany is one of the better ways to measure what's going on in China because they're such great trading partners. Now, while China does hide all their data, puts out all kinds of accounts that have no accountability in terms of their accounting, Germans are not such. It's a democracy where there's full accountability. And so it's hard to hide the truth if we base our judgment on what German bonds are doing. So this is just absolutely insane. Imagine you had to pay 60 cents on the dollar or on $100 per year for the right to loan Germans money as their GDP, as they're basically in a recession headed towards worse and worse times. It makes no sense. So you got to ask yourself, why is there so many speculators loaning money to the German government for the prospect of paying them 60 cents per year, so over 10 years, to loan them money? It makes absolutely no sense. So the idea is that the rates are going to get pushed lower, and eventually their central bank is going to have to come in and massively start buying up their own bonds, and that's how everybody gets out of this position. So until they come in there and start to buy it up, I believe the tremendous capital that is leveraged into this trade, and it's not just pure dollars that are being invested into this. You can count on its huge amounts of leverage and credit being used to buy up these positions. So until these central banks really come in, start up QE, peg the rates, stop this trend, I believe it will continue to get out of control and go lower and lower. But we may be getting close to that point where the banks throw up their hands and say, all right, we got to let these guys out, buy up the bonds, and try to control our yields because this is obviously not sustainable. So there's our 5-year look at that German yield. Last time we had a situation similar to this was when China was running out of growth in 2015, And their response was, again, to massively increase their monetary supply and their debt by creating more and more infrastructure. So they've already built more houses than they know what to do with, times 10. In fact, there's so many houses. They have this gigantic overdevelopment of housing property where they don't actually build the apartments. It's just a bunch of empty concrete blocks that they're flipping between one another. So that game is up. Next, they tried to expand their credit and keep their GDP healthy by essentially doing this Belt and Road Initiative. So if you watch some of these YouTube videos, these guys are out biking around China. There's no plumbing in many of their cities. There's no roads. But what there are these banners of President Xi talking about how they're going to go spend trillions of dollars on the Belt and Road. So now, instead of taking care of their own people, they're going to go build infrastructure for everybody surrounding them in hopes that they can keep this GDP from crashing too quickly. And I think they're starting to realize that they can't. And we'll look at some tweets or some news wires from President Xi indicating that there's a hard road ahead, and I think they're starting to realize that they're going to have to make some pretty serious choices here. So, okay, here's the important content I pulled out of Twitter over the last 24 hours. Donald Trump tweet, Germany and so many other countries have negative interest rates. They get paid for loaning money, and our Federal Reserve fails to act. Remember, these are also our weak currency competitors. So from that point of view, America is paying a little more interest than the rest of the world, sure, but it's making it very easy for us to sell record-breaking amounts of treasuries week after week. So we're funding our government, creating a huge amount of money for the government to spend, which of course helps goose up our GDP, which keeps the credit ratings of all these important companies in the States profitable, which keeps their ability to borrow money from the corporate bond market strong, which is feeding this corporate buyback loop. So if it seems crazy, it certainly is. The market is definitely working the exact opposite of how it should. Think about it. Usually if someone has bad credit, they're going to pay extra interest. But the way this is working out, the countries with the worst credit are being able to drive their bonds into negative yielding interest because they think they're going to get bailed out by their central bank. So working exactly the opposite of how it should, and something to really look out for will be once these central banks finally do capitulate. I believe we'll see the entire rate market have to prop up a little higher. Makes no sense for this to be in negative territory, so we could see a major sell-off in credit if that were to happen. Depends on where the central banks decide to peg these interest rates, and then that can quickly reprice through the rest of the credit market. So if it's not too nasty of a yield hike or a drop in bond value, at which point the central banks cash out everyone, then we may see just a huge flood into equities and then maybe a flattening out on the TLT at a little bit lower price. So we'll have to keep careful eye on that. Okay, Donald Trump, for all of these geniuses out there, many who have been in other administrations and taken to the cleaners by China, that want me to get together with the EU and others to go after China trade practices. Remember, the EU and all treat us very unfairly on trade also. Will change. Just my thought is we got to be careful not to pick too many fights at once. China may be plenty to chew on just in itself. We are doing very well in our negotiations with China. While I am sure they would love to be dealing with the new administration so they could continue their practice of rip-off USA at $600 billion a year. 16 months plus is a long time to be hemorrhaging jobs and companies on a long shot. And so the point is that these companies who are bailing out of China probably won't ever come back. They're probably going to rebuild somewhere else, and that's that. So while U.S. is losing perhaps long-term farming agricultural deals, primarily soybean, maybe even pork, China is losing much more critical part of their middle of their economy, which is all these manufacturing jobs. So I do think that China will take a bigger hit relative to the U.S., which helps support our strategy right now, being long equities and bonds. And then think what happens to China when I win. Deal would get much tougher. In the meanwhile, China's supply chains will crumble and businesses, jobs, and money will be gone. Now, here's where we got to get a little worried about U.S. equities. Is this. Chinese President Xi Jinping of China tells its citizens they should be prepared for a long-term struggle as China's development is entering to a period when various risks and challenges are emerging together. The struggles we face will continue at least through 2049. So my read on this is that, you know what, if U.S. wants to put tariffs, that's fine. We will devalue our currency. U.S. wants to take out Huawei. I would look out for reciprocal threats towards Apple and, of course, to all the U.S. farming agriculture that's used to selling to China. Okay, I don't think they're going to violently attack the U.S., but rather continue to mildly respond to attacks from U.S. From their point of view, they want to try to replace all of their technology and reliance on the U.S. and focus on serving the Eurasia area, which means a big step back, but it allows them to continue to essentially have a tiny group of people controlling China that get to hog all the money, which is the Communist Party. Tiny, tiny group of people. That's number one. Two, it allows them to continue to tax their citizens at something around 70 to 80%. It allows them to continue to have spies all over the world, stealing as much as they possibly can and rebuilding it to sell to China. It's a lot cheaper to steal someone else's invention than to go spend all the money, research and development to innovate yourself. So it's really asking them to give up a lot of their advantages as a country with what the U.S. is demanding. And apparently they don't want to cave in to any of it. They don't want to stop subsidizing the key industries that they want to dominate in, which means other companies around the world have no chance to compete when they are essentially taking all the profits of the whole country and then laser focusing their investments into a few core categories. So number one, they don't want to give up their subsidization into key industries to give them an advantage. Two, they don't want to lose control over their population in terms of censoring, in terms of super high tax rates. So think of Hong Kong standing up to China. This is probably getting word into mainland China, which will cause unrest. So there are a lot of questionable things about this. Taiwan continues to state that they're their own people, while China claims that Taiwan is theirs. Meanwhile, the U.S. is selling fighter jets to Taiwan, and the Hong Kong protests continue to really get out of control. So we will see, can China really pull this off, or are they going to go bankrupt and create a massive financial crisis around the world? Something very questionable to look at. I also watched a really interesting video about China's history. They're some 4,000 years old. They've had good runs, they've had bad runs. They essentially think U.S. got lucky, that they are weak, fat, lazy, too nice, and China's doing everything they can to take advantage of that situation. They believe they are a far superior race of people, that they have a better way to organize a community of citizens, and that the U.S. is somewhat foolish, devilish, all sorts of bad connotations from their point of view. Now, that may not be what the average citizen of China thinks. For sure, it's not. Imagine you can't even type something to your friend without it being automatically deleted if it's anything negative against the government. So they certainly have some advantages, and we'll see how this all plays out. But this is certainly the most alarming tweet in terms of being bullish equities for a long period of time. Let me get back to that. Because if China does not give in, we got to really start to speculate how much pressure will the U.S. continue to put on China to get them to act like the rest of the world, to stop cheating, stealing, subsidizing products, etc. How much pain do we have to put on their country before they will make changes? Number one. And then number two, will that pain end up working itself throughout the whole world and hitting the U.S. into a recession before the 2020 election? So a lot of unknowns. These are the key things to keep track of. Some PMI data getting a little hairy this morning. 49, anything over 50 shows growth. So we have two of them over 50, but one dropping a little lower today, mainly related to exports. But if you think about it, the dollar's become super expensive. So if the Fed does drop 25 basis points, I'm now thinking September, maybe 50, that should weaken the dollar, help the exporters, and I think that will pop up. Meanwhile, China's back to increasing their line of credit. Short term, that's always positive to risk assets. So you can see China's PMI rebounding here as they're devaluing their currency, printing money, going into more debt. And so I don't think the U.S. Bond market can go into negative yielding territory because there would be no outlet for profit in the bond market. And so it's a little complex, but I really think that the U.S. Treasury can only go so low before the entire thing would really capsize on itself. So this is a 10-year chart of the U.S., and you can read the tweet. 10-year real yields are now negative. At the same time, we also have long positioning in safe haven assets, the yen, gold, treasury, cash near 10-year highs. Yet growth is still positive in the U.S., and global weakness looks set to moderate in the next 2 to 4 months. And again, this is due to another splurge in credit, not because everything is hunky-dory. Hong Kong authorities have warned that radical protesters showed signs of terror. More than 1,000 have been arrested. Now, this is all relating to the Tiananmen Square incident. Depending on who you listen to, at least 1,000 people were killed. I've read accounts that some 10 to 50,000 people were murdered. The police went through the streets to houses of anyone who had been noticed. Didn't matter if you were a kid of the Communist Party or not. If you were part of the Tiananmen Square, which was something like a 2 or 3 month protest, it ended in insane bloodshed. They have forced all the big American tech companies to essentially censor as much content as possible related to Tiananmen Square. We've seen Trump say that word in the press, which is a huge no-no. There's never been another president to bring that up publicly. That's a bad etiquette when you're dealing with the Chinese Communist Party, because the last thing they want is their slave population wanting freedom of speech, lower taxes, ability to get their capital out of China. So we're seeing this continue to escalate. We're now something like 6 weeks into this protest, and this is something clearly we need to keep a careful eye on as it continues to deteriorate. And that is a wrap for today's presentation. If you, again, want to activate your account, call Dean at 505-322-7515. Tomorrow we'll be trading the SPY ETF, and Thursday we'll be playing the TLT ETF right at noon Eastern. Don't forget, for our paid group, we do have a live webinar tomorrow at 1 Eastern. And for our free folks, you're invited to another webinar Thursday at 1 Eastern. So thanks again for your time, and look for a new Trade Alert tomorrow at noon.